What's going on, guys? Welcome to another Market Radar podcast. Hope you've had a great week. We've had quite an eventful week in the equity space. The NASDAQ has turned bearish trend. We did talk about this last weekend when it was hovering around Momo and all other indexes were bearish trend. We did mention that there's going to be some downward pressure on the NASDAQ, and sure enough, that was true. Now the NASDAQ is also bearish trend. All four indexes are bearish trend. So I think it's safe to say that what we've seen basically since the start of the year, this was the true bear market rally. All the other rallies that we've had, so June in 2022 and March 2022, those were not the real bear market rallies. This, I think, is safe to say this was the bear market rally, and the bear market looks to be continuing, especially based on our system, on the growth component that our system is looking at. It's actually much lower than it used to be. We did have a theory where we thought maybe during this stage 3 of the compound landing, equities might actually be able to squeeze out a rally and maybe even hit new all-time highs. We didn't quite get that. I don't think we are going to get that anymore based on the way the growth outlook is looking now. And especially with the inflation aspect coming under control, we don't have that inflation pushing equities up either. So yeah, it's looking like the bear market is going to continue. It's possible we could still get chop here. I don't know if we're really going to head straight down to the lows. But what do you think, Gamma? Do you think it's possible that we could just head straight to the lows in a very quick fashion?
Obviously that's always a possibility, especially when you're in bearish trends, right? So it's the fact that all the major indexes are in bearish trends, the door is open for rapid downside moves. Now, going back to what you were just saying, where we were making the claim that equities could perhaps make new all-time highs. Some of you guys might not understand where that's coming from, and that's coming from the fact that stage 3 can live a lot longer and act a lot more act much more irrationally than most would want to think. Obviously, then leading to stage 4, and in that period, you could get a continued rally in equities. Now, all of this changed as soon as the indices started actually flipping to bearish trend from the bullish trend that they were in, right? Because theoretically, even if you have a bearish outlook on the market or a bearish outlook on the economy, the stocks are bullish or the indexes are bullish, you have to give the credit where the credit's due. And that's what that whole idea of saying stocks could squeeze out new all-time highs or indices could squeeze out new all-time highs, basically saying that bullish trends will continue until they're stopped. And stage 3 is this whole effort of trying to normalize the economy at higher interest rates. So maybe they take equities a lot higher and a lot more in a lot more of a euphoric fashion than most people would want to believe. Obviously, that all changed when these indices went bearish trend. And the first one of the big flips at the end of last month was the S&P 500. We went over this in multiple podcasts, but basically said that as long as the S&P is ES, right, the S&P futures are under Momo, it's cooked for the spews. And pretty much it has been. They couldn't break out here in mid-October, and they've since shit the bed. Okay. So NASDAQ, we basically said that the NASDAQ would be next if nothing changes. This was basically a foreshadowing of what was to come or what is to come in the NASDAQ. Now, the NASDAQ flipped trend this week, finally closing in bearish trend. Now, it's very simple. If you want equities to go higher, they have to clear Momo on both the NASDAQ and the S&P 500. So meaning, if you want tech stocks to really run from here, the NASDAQ has to get back above 15,000. If not, the bearish trend can continue, and bearish trends, as I said earlier about bullish trends, will continue, and until they're stopped, they can go on. So bearish trends tend to lead to lower prices, and bullish trends tend to lead to higher prices. But that's pretty much that for the major indices this week. And we can go right into bonds because obviously a whole lot of nothing has been going on here. And everyone is pretty much antsy to get on this bond trade. So before I go into bonds, let's do a quick recap, though, on what happened in the week, because the bond trade is pretty simple. But to get an understanding of what's going on here, I think we should just run through the economic data this week, and we'll start with building permits coming in down 7% from this time last year. So they're down 7% year over year. Now, obviously, the housing and construction market has stress from higher interest rates and tighter credit conditions. Now, following building permits, new home sales were actually up 34% from a year ago. Sounds real great. Sounds awesome. Nice recovery, but they're still down over 25% from their 2021 peak. So there's still there's obviously some stress there again due to tighter credit conditions and higher interest rates. Now, the big talk of the week was in fact GDP. It came in at 4.9%. Now, this was below the Atlanta Fed model of 5.4%, but higher than the Wall Street consensus of 4.3%. So GDP came in hot. Obviously, you had the group of people on the internet, Twitter, claiming that the numbers are fake, false print, it's broken, it's manipulated, pretty much that ball of wax. And that's all a bunch of bullshit. The numbers are the numbers. They can be manipulated however they want, but the market's going to interpret what it is seeing. And obviously, this is a big important number for the market. So the market's taking this number. And even with the market taking this hot growth number, it's still shitting the bed. So obviously, you have to understand what the market's looking at. It's not taking this at face value at all. And that's very important. Obviously, our system doesn't rely on one specific number. Neither should yours or your process. It should be broad-based, look at as many data points as possible, and come to a valid and balanced conclusion.
Yeah, I want to add something to that. So it is interesting how the GDP number didn't really affect bonds, didn't affect equities too much, especially just because our system is looking at what the market is pricing in, right? And the market's been pricing in growth going absolutely in the shitter. And so it surprised me that a GDP print this positive did not take the market by surprise or anything. So the market is still forecasting growth going down even after a GDP print this high. So what does that mean? Obviously the market's forward looking, but it's kind of surprising to me that there wasn't any reaction from the market with this GDP print.
Well, remember, the GDP print is wrapping up the third quarter, right? We're in the fourth quarter now.
Right, but with that kind of momentum, you'd think that if the market is pricing in growth getting completely decimated, wouldn't there be some sort of mispricing and repricing after a GDP print like that? And with the market kind of realizing, oh, okay, you know what? There actually has been a lot of growth, and maybe it's not going to slow down as soon as we think.
Possible, yeah. So, just remember, equities like the S&P, right? At one point, we can go from the time it flipped bullish trend. That's probably the most accurate for us, right? So it rallied as high as 22.8% on the NQ, not the S&P. The Nasdaq futures were up almost 23% from the bullish trend flip in early April, right? Now, the Q2 and Q3 GDP numbers have been pretty good, right? In terms of obviously there's no recession. The market's baking that in. Now the question is, where's Q4, Q1, Q2 of next year, right? That's where the market's going to move to. The market doesn't care about Q3 anymore. That GDP print didn't move the market because the market's not really it's not too concerned with what has already happened, right? So the market's going to be focused on where everything's going. And I think that, yes, okay, we have a strong GDP print the forecast was 5. It came in at 4.9. I think it's going to be hard to get a recession right from 4.9, right? This is not a COVID type of situation. We had the Atlanta Fed model updating for Q4 of this year at 2.3 or something, 2.25, something like that, right? For the fourth quarter. So obviously we're still off that. We're still quite a bit away from that negative GDP print, right? And could things change over the next 3 or 4 months? Sure. But I think the market's starting to pick up on the idea that there was no substance behind that growth move. Could it be because it was mainly from excessive spending on a government level? Possibly, right? Not that to say that the government bought the numbers, right? They bought the GDP numbers, but it's possible to a degree that government spending and stimulus is still flowing through the system, obviously, and giving like a temporary boost to something that really shouldn't have happened. Obviously, we can't fine tune things out and decipher things down to a T like that. But what I can tell you is that in a bull market where GDP should be continuously strong, market all the major indices shouldn't be all in bearish trends. So there's something just to say there. Forget the system, put everything aside, just take a real simple approach. All the major indices are all bearish trend now. If things change, obviously we'll update that and we'll take advantage of any shifts that happen as we go along here. But it doesn't look very promising at the moment, right? In terms of just like upward momentum. I mean, there could be chop for sure, but given that all indices are now bearish, the downside risk is really there. Is it going to be Is it going to be an accelerated move? I can't tell you that, but VIX is at 21, right? So there's a lot of implied volatility being priced into the market. Now, obviously, people are getting more and more scared. And as people get more scared, they have a tendency, and things start going down, right? And they don't stop going down, kind of like a snowballing effect. And now there's also something to be said about volatility, right? And I don't want to get too far off your point of how do we handle that in terms of what the market's looking at going forward. But the market's also a very unique thing because a lot of people like to look. There's certain things that have cause and effect, and there's certain things that do not have cause and effect, right? For example, VIX going to 50 is not the reason the stock market crashes, right? VIX going to 50 is because the stock market is crashing. They're happening pretty much at the same time. What I'm trying to say is just because the volatility is high or just because stocks are down doesn't mean that volatility has to go down because it can't stay at 21 forever. I don't know. Some people like to tell a lot. There are people that like to illustrate this idea that vol is mean reverting and it'll always go down over time. That's true in the futures perspective, but vol is where it is only due to where the market's been trading, right? And when the market goes straight up like this, we were down in, let's take a look at VIX, right? VIX was down into the low to the 13s. Now we're at 21. And VIX went bullish trend on October 3rd. And again, another signal. Be careful in the markets. These are not all growth positive things that are happening here. Obviously, economic numbers are poor, right? You can say that there are some that are rebounding. And I'll go back to that now to finish that up. I mean, we had continuing claims coming in this week, rising again. We're still below the highs made in April of this year, but we're up 38% from the 2022 lows, excuse me, where it was like peak unemployment, right? Or I should say, the peak right before everything shit the bed in terms of economic data. And then we also had PCE year over year come in at expectations, excuse me, guys. And the same as the prior print. Now, core services X housing is floating around on the internet. That is absolute and utter horseshit. And I don't recommend you waste your time with that noise. There's no reason to be looking or reading about core services X housing because you're looking at a fraction of the data that matters. Stick to the main numbers, the things that everyone has to deal with. Isolating something in a CPI basket is about as useful as, shooting your legs off before a marathon. So by you isolating those data points, you're looking for sticky data because that's the stickiest part of the data set, right? Core. And then you isolate it even smaller and you end up in just it's like the super core inflation index. You're just isolating things to prove your point that inflation is still prevalent. But in reality, inflation has moderated heavily since this whole thing peaked up in the summer of last year. And I think that worrying about all these minute things is just unnecessary angst, and I don't think that's a good idea. But let's roll back into what else happened this week, right? Bitcoin, major move in Bitcoin. Bitcoin flipped bullish trend on October 21st, 2023. Since then, ripped aggressively, and we are now above $30,000 a coin. Actually, closer to $35,000. The question here is, are you long? Should you be long? And the answer to that is in our daily weather report. We have our position listed there, and on our position on Bitcoin after this move or into this move listed on our weather report. You can find that on our website at market-radar.com. It's updated daily, and we give all types of insight of macroeconomic data points and our models and our portfolio allocations based on our tools. That being DDAP, which is what you see on the screen here, and the system, which is provided in our reports. So let's move on to the 2s and 10s, though. This is obviously edging higher week over week as the stage 3 part of this compound landing framework continues. Now, what's going on here? We are still in a bear steepener for the most part, or how that's being illustrated is by the study here on the bottom, our yield curve analyzer. It can be added to your charts. You can just add it by typing indicators and typing curve analyzer, and you can add it to your charts like this. So we can see here that bear steepener has been dominating the price action in the 2s and 10s in the 10s and 2s, as they revert towards zero. And now ultimately, I want to bring up the point where a lot of people are thinking, well, once we get to zero, the recession's here. They're saying 16 basis points away historically. That is what happened. You get the reversion to zero shortly after there's a recession. It very well could happen this time. But you have to be careful because this is one of the most prolonged recessionary cycles in terms of not the most prolonged, but it's a very prolonged recessionary cycle where we've been inverted since July of 2022 on the 10s and 2s, and we've been pretty much going all the way down to some of the deepest inversions seen in 30 years, and then reverting back up, and still not in positive territory, and still inverted over a year's worth of time.
Based on how things have been going over the last 2 years, everything that was supposed to happen has not happened. So continuing on with that trend, I think everyone is expecting a recession to hit once the yield curve reverts. That's kind of how it usually goes. And just because of the way things have been going, I don't think that's what's going to happen. It's the opposite has been happening. And so I think the likely outcome here is the bear steepener continues. We might even head above zero with a bear steepener and still not get a recession until we start getting that bull steepener pushing the yield curve higher.
Right.
And getting that bull steepener reversion.
Yep, exactly. So the way to sum that up, saying that this time is not the same as what everyone's been expecting for so long, is a great way to put it. And that I want to clarify with this whole statement that the reversion is not a stage 4 signal. That is not a stage 4 signal. That's not something that will cause stage 4. That's something that would tend to happen with the back end of a recessionary cycle, or going into a recessionary cycle after the peak out in the economy, right? You would see the spread revert, go above zero, and then you get the recession. But that's not necessarily the driver of stage 4 in this cycle. I just wanted to clarify that, and I think we got that point across. Now, to wrap up this podcast, I do want to go over a quick explanation of DDAP. I know some of you guys are probably new to the podcast. You don't know what DDAP is, but DDAP is our TradingView script. You can get access to the script by becoming a member on our website at market-radar.com. And then once you input your information, we will add you to the script and you will have access to it on TradingView. You'll be able to add it to your charts and chart any ticker you like. For example, you can type in Apple, you can type in AMD, type in Google, any ticker you'd like, you can chart in real time on your own terms and basically run it within the confines of your own trading system. You don't have to rely on a report for certain levels, ranges, pivot points. It's all on your screen, on your own time, and this is available it's all included in our package that we offer, our reports and our Discord access. And again, that can be found on our website at market-radar.com. Thank you guys so much for listening. I hope you guys enjoyed, and we'll see you next week.